Okay, so yeah, don't do too many YouTube interviews here, but I had the privilege of introducing Jeff Booth, who is a tech startup founder here in Vancouver. He actually wrote a really popular book that I'm currently reading right now called The Price of Tomorrow. And Jeff, I first discovered on Real Vision. We also have Michael Stephenson, who is the CEO of a startup called Addy. They're from here from Vancouver, and they're doing a real estate startup. So I figured the combo of the two kind of go hand in hand with what this channel is all about. So I kind of want to get this party rolling, but we'll start with Jeff. I mean, Jeff, for the audience that isn't quite aware of your book and of some of your work that you're now being quite talked about. So you've been on Real Vision. I saw you on Macro Voices. You've been on a whole host of other podcasts with some pretty big names. So for those who aren't quite aware, can you tell us a little bit more about your sort of thesis and what your book is all about?
Sure. This is going to be hard for a lot of people, your listeners, to kind of comprehend what this means. But today we have two giant forces competing against each other. And I would say those forces competing against each other, the second order effects of wealth inequality, uprisings, revolution, everything that you're seeing in the media is a polarization of the political landscape, or second and third order effects of these two forces. And those two forces are technological deflation. So when we use technology, we drive efficiencies. And that efficiency drives into price reductions and abundance for that as price reductions. And that's the natural order of things. So as we're on an exponential trend of technology, driving more and more efficiency to market, which drives prices down and abundance up. And so that's deflationary in nature. It makes prices cheaper. Against that force, we have governments and central banks trying to create money or debt, first debt, to try to stop deflation from happening. And then over time, not just debt, but monetization of debt and destruction of, and it's essentially destruction of money through inflation, then hyperinflation, to try to stop what's naturally there all along. And so as you do that, as governments do that, as central banks print money, then asset prices don't fall. So that what you're seeing in the stock market today, what you're seeing in real estate prices today, what you're seeing in commercial real estate prices today, those prices should have fallen. We're on Zoom right now. Many other businesses are as well. So you would not expect commercial real estate to be where it is today if 50% of the population isn't in that commercial real estate. So it's one example of what's happening. But if you keep on pushing that price up through monetary, saving that market from falling, then you prevent capitalism's naturally clearing cycle, and government becomes more and more of the market. So what ends up happening is they print, causing a whole bunch of wealth inequality because the money goes straight into asset prices instead of the real economy. They take money from the real economy to do that. And then on the opposite side, a whole bunch of people that cannot pay for those increased asset prices, like housing, food, everything else, rise up and demand socialism to be able to pay them for something that was taken in the first place. So through that, ultimately at the end of the day, governments are not going to be able to stop technology advancement. And the technology advancement is deflationary in nature. And that means rewiring our societies and monetary policy to understand that. But they're going to try.
Yeah, no, I think that's excellent points. I tend to agree with pretty much everything you've kind of highlighted. And certainly I've talked about, a lot of my channel is a lot about the monetary policy that's underway. So basically you have, as you mentioned, you're from the tech side. So you have tech, which is creating these deflationary forces, lower prices. But you also have debt and demographics, which I'd argue are also deflationary. At the same time, the central bank has this implicit mandate that they're almost beating their heads against a wall trying to hit an imaginary 2% inflation target. and they seem willing to do anything to achieve that 2%, despite the fact that you have natural forces that are trying to create deflation. And so I guess, and I think anyone, particularly in Vancouver, which is, most of this audience, and I guess you could say Toronto as well, is that you look across over the past decade, and the Bank of Canada has come out and told everybody that inflation, or CPI, is hovering just below 2%, pretty close to their mandate, but slightly below it. And there's really, by their standards, almost no inflation. But if you look at the average person and you ask them what inflation is running at, most people in Vancouver, Toronto, Montreal, any of these big cities will probably tell you inflation is close to double digits. And that's primarily, I mean, you could decipher that it's asset inflation, particularly in housing and real estate, which is the largest component of our GDP, really, or one of them, other than consumer spending, obviously. But it drives a huge component of every person's life. So, do you like what are your
let's go into that, because it's something that Bank of Canada can't solve, nor can the Fed, nor can anywhere else, because we play in game theory. This is a multiplayer game. Right? It's currencies all around the world. And so to look at what's happening, you really have to look deep. So if you buy the premise, and by the way, and that's a fact, technology is deflationary. It's exponentially deflationary. So that's not a guess, it's a fact. There is not a CEO on the planet that puts technology into their company so that their prices go up. Right? What you do is you remove labor with the technology. In fact, the technology is supposed to free our time. What's not freeing our time is warped policies that stop us, that keep us on a treadmill to try to work more and more to try to pay for ever rising prices that were created in the first place by central banks. So just understanding what inflation or deflation is. Inflation is, when you said 2% inflation mandate, inflation is, all it is when goods and services cost more versus your money, right? So, and deflation is the opposite. Your money is worth less, goods and services your money is worth more, goods and services cost less. So if you look at those two, different winners and losers on either side of that. But if you were an individual, you would say, I want my money to be worth more, and goods and services too. Yet somehow, when we rise that up to a society, we say, no, we want inflation. We want prices to go up, right? So it's worth considering that in what's happening, because technology is about march to efficiency and driving prices down. And it's up against central banks' policies of trying to make prices go up. Why? Because we have too much debt, and if you don't have inflation, the debt resets, because the debt gets more expensive in real terms, because the deflation makes you. So now let's look at the evidence that support what I'm saying. So technology deflation is happening, and today, actually pre 2020, when I wrote my book, we had $250 trillion of global debt to run an $80 trillion global economy. And $185 trillion of that debt came in the last 20 years. So $185 trillion, $4 of debt for every $1 of growth in the last 20 years. And it's getting worse. And you can't solve a debt problem with more debt. But because the central banks missed a structural change, like Blockbuster missed a structural change and missed to Netflix. Central banks missed a structural change that technology is moving this way and could provide abundance to everybody. They doubled down on debt. And so that debt, now that was pre-COVID. Now the debt has exploded way higher and the economies are smaller. And if they remove that stimulus, we have a massive depression. That's what it looks like.
Totally.
So the probabilities are, so they're trapped. And if they did that, which they won't, which would be political suicide to do, so they won't, then you would have asset prices collapsing by 80, 90%, stock prices collapsing. It would look like the Great Depression on steroids. And banks would fail and everything else. That's what it would look, that's what the natural order of things would look like. So instead you have a Ponzi scheme of money creation. And the next step, by the way, the Fed, so changing asset prices isn't moving into the greater economy. So you can expect the next step of this for the Treasury to essentially to become the Fed, the Bank of Canada, you everywhere, and do a direct transfer through helicopter money or UBI, which would let loose hyperinflation or a path to hyperinflation, which would destroy the value of currencies all over the world. So that's kind of the path that's in front of us.
Yeah, I think you're almost you can kind of see the early steps that you're kind of going down that. I mean, if you look at, for example, we'll keep it Canadian for most of our viewers here, but like most people are aware what the Fed's doing. But you look at the Bank of Canada, I think that what they're doing now, they just come out since this pandemic. Well, we're committed to buying $5 billion worth of securities every single week, and that's going to continue indefinitely until the recovery is well underway. They've already told you that interest rates, they're going to keep them pinned to the floor. So you can kind of see that that's just kind of the path that they're already going down to avoid that deflation and to avoid that asset price collapse.
And Steve, why that's important to say, zoom out from just Canada, really important. Is if you say what's driving real estate prices, it's not just Canada.
Oh, totally.
So if you're in China, and you know the only way that they can kind of keep the economy going is by destroying your currency value, then you're going to take your money out of that currency and put it into our real estate. And there's nothing there's nothing governments can do to stop that. And that's a global phenomenon. And it's happening all over the world as people are looking for safe havens on assets to prevent from what's coming.
Yeah, totally. And because every central bank is working in unison, effectively, engaging in asset
competitive devaluations.
Yeah, exactly. So competitive devaluations, essentially eroding people's currencies. And that's the flight into assets. So just out of curiosity, this is for Jeff, and then Michael, you can comment on it as well. With that, because you're from Vancouver, do you have a specific view on Vancouver real estate and say the short to medium term, and then obviously the longer term, like given your sort of overlay of policies?
So the short to medium term, it should have collapsed like crazy on COVID, everything. Why isn't it? Is because of these policies, and these policies you can expect that they're going to continue all over the world. So real estate is a safe haven against that, or is one of the safe havens against that. So you could get prices that go to the stratosphere. In real nominal terms, what you could say is your currency is being devalued. That's why real estate's going up, right? That's what's happening. And so if you put your money in the bank, essentially the governments are stating it in their mandate, or the central banks are stating in their mandate. They're saying through negative interest rates, or almost negative real interest rates, they're stating to businesses and everyone else, don't save cash. We're going to penalize your cash and make it worthless through inflation. That's their policy. So in an environment where they're telling everybody, don't save cash, why would a business hold cash on their balance sheet? Why would you personally hold a lot of cash? And you would hold cash in the event that they drive fiscal responsibility and cause a depression, and then you could pick up assets for pennies on the dollar. That's why you would hold cash. But otherwise, you wouldn't hold cash, and that's why that's actually why the system is becoming more and more unstable. When you look at an airline that says they do, or any company, any CEO that does stock buybacks, why would you hold cash for a rainy day when the government says we're going to make your cash worthless? You get penalized in the free market and their stock price goes down. So you use that cash to buy back stocks, and you make the system ever more fragile every time you do it. And so the government's policies, all central banks' government policies, are making the system more fragile.
Totally. You're creating, through that almost Ponzi mechanism, you're just enticing more and more debt. So then the debt buildup almost becomes more and more. You create more vulnerabilities or unsustainable debt piles, but it has to continue because you're so far down that beaten path.
And that's it. It has to continue until it doesn't. Yeah. And so even the debt itself, the central banks have this crazy belief that the debt itself is inflationary in nature. It's not. It's actually disinflationary because taxes must go up to pay back the debt, right?
Totally.
So that those taxes, you're robbing the future because the taxes must go up in the future to pay for the debt. And so what's happening is as you push on that string, you realize I can't raise taxes because the economy collapses even more. I need to monetize that debt through hyperinflation. So you can expect through this cycle at some point the central banks to give up their mandate through lending through bank. Because if the central bank says, banks, you have to lend more, the bank takes off bad assets off their balance sheet, gives them good assets in that money transfer. Yes, it drives asset prices. But for the economy to function, there has to be good businesses to put money into. And there has to be a demand for loans. And so you can see that policy isn't working to get to Main Street. So you can expect the next step of this cycle that Treasury will become, or government will become the Fed, or Treasury will become the Fed, and you'll go through UBI or direct transfer, which will essentially break the fundamental promise of money as a store of value all over the world, and you get hyperinflation as a result.
I think I was actually looking at the numbers. I think in Canada, again, for example, like by the Bank of Canada purchasing $5 billion per week, I think it's actually greater than net issuance of government securities. So they're effectively monetizing the Liberal government.
Yeah, and so it's just a debasement of the currency when it happens, and so again, assets that protect you from that debasement of currency. And by the way, this pendulum through history has gone back and forth. And this is what always governments try to do before the currency is debased. And maybe ask why. What is inflation? Inflation is just a hidden tax, because government's inability to charge the tax rate to pay for the services that they think they require to expand government, they hide it in inflation. The problem with inflation is it's a tax on the most vulnerable, unable to pay it. Right? Because if you're working for wage, if you don't have asset prices, if you don't have assets, housing, and everything else that are going up in response to this, and you have wages, your real value of your wages is going down. And so I'll use an example here, local example. My cabin, before I built on the cabin 7 years ago at Cultus Lake, was just an old cabin, 2-bedroom cabin. And 7 years ago, in the winter months, I could only rent it for $600 a month. That same cabin, mine's rebuilt, but that same cabin down the street is renting for $1,500 a month. So and so that means unless your real wages have more than doubled in the last 7 years, you've lost purchasing power. Why do you think in an environment like that there's a rise to socialism and a whole bunch of people missing out and angry at the system? And ironically, they're looking at the same government who created the problem to solve the problem through the same issues. And it's because they haven't understood, nobody understands, including central banks and everything else, that we have a structural change in society that requires different rules.
Right. So getting to that now, I think that's a good transition, is what is your sort of proposition for central banks, essentially, that we know that this game cannot be sustained. They're creating real winners and losers. So if you're looking at that from your perspective, technology is deflationary, and everything that they're doing is, they're fighting a deflationary battle that they cannot win. What would you propose? What is the solution?
So this is going to blow some of your listeners' minds, and especially if you don't. But give technology. So why do we use technology? Because we gain time. Right? The most valuable things in our life. The most valuable thing in our life is time. It's just a silly thing. So what we're doing is trading our time to try to gain asset price inflation, so that we can retire our last part of our lives with have time to enjoy the things. When it's here right in front of us, the solution is right in front of us. If we allowed prices to fall along the natural order of things, then it wouldn't require the same amount of jobs, because you can't price things. People think they complicate economics. Economics isn't about value. Economics is about scarcity, and abundant things you can't price. The air you breathe right now is free, yet it's the most important thing in your life because it's abundant. And technology creates that abundance everywhere. And so the natural order of things is if we allowed that to happen, the technological benefits of what's happening, all of that entrepreneurial talent would be creating opportunities while there was still opportunities to create money, the entire time driving price down. And you could enjoy your time, so that if you fell off a job, you didn't need a $300,000 job to pay for prices that were manipulated higher in the first place. So the manipulation is causing all the problems. I manipulate prices high in the first place to keep up the Ponzi scheme. And then a whole bunch of people revolt, and I need to give them money to pay for the prices that were manipulated in the first place. It couldn't be opposite. It couldn't be more opposite than a free market. And there's only two ways to organize labor at scale: free markets and communism, or to socialism. And those paths, socialism leads to the biggest thug. It says government controls everything, and eventually look at Russia, look at China, once you're in control, you control through force. So free markets aren't perfect, and there has to be some checks and balance in free markets. But history has taught us that it's the best way for society to organize labor and run a capitalist to organize entrepreneurs to be able to deliver the best for society. In fact, an entrepreneur fails unless they deliver value to people. The company doesn't work. So why are we stopping that function?
Right. Yeah, no, I agree. What do you have, like, I mean, I'm sure you get some pushback on that in terms of, like, so now that we have all of this debt that we've accumulated, and if you have deflation kind of driving that, doesn't that, makes those debts a little bit more difficult to repay? How do you solve for that? Is it like a debt jubilee, or is that?
So if you did a debt jubilee, then what you're saying is, the architects of the crisis, all the people with debt, like say the central bank said, I'm going to buy up the entire world for trading, and then I'm going to own the entire thing through a debt jubilee, right? That's what you do at different various levels. So you can't do a debt jubilee. You have to force bond debt holders to come to terms with reality. That is and so there's only two clearing functions: hyperinflation, worthless currencies, or controls, where so the market will force force price correction. It's just when will the market, or austerity, which will force. And if the governments don't force out the austerity, the markets will force out the austerity at some point.
So is that an eventual collapse in asset prices then?
Not before a staggering rise in asset prices, because the governments they'll try to get away with this, right?
Yeah.
So for listeners that are looking at this, this is covered in my book extensively, and a whole bunch of other things, but there's certain places where you can protect value, and you need to look at different areas where you can protect value. So one place that people have too much risk typically is everything is denominated in their local currency, right? And so you can ask the question, why don't people in Weimar Republic leave, right? Why don't they, when they see that what's going to happen, and they see all the dislocation of political discord and us versus them, and wheelbarrows full of money to that by, why don't they leave? Or before they see some of that, why don't they leave in Argentina? Why don't they leave in Turkey today, or Lebanon today? And it's because typically all of your assets are denominated in the local currency. Your housing is, your job is, your everything else, and you're leaving as a refugee, right? And so you long for a better day when it looks different, and you stay in the same silo that reinforces on that. I would say one of the best asset classes around right now to protect people from that is Bitcoin.
Yeah, I agree.
It's a life raft away from that, and I think it's irresponsible not to hold some in your portfolio. I'm not saying go all in or anything else, but I think it's irresponsible not to hold some in your portfolio, because some of your listeners will say, but it's not a store of value, it's not a currency, and I kind of go, it's incongruent that you can 100% believe that in a currency that is being manipulated, and not believe in something of a store of value that cannot be manipulated. So I would ask you others to look deeper on why that is, because I think it has a tremendous run ahead, not for the financial value, for the safety valve of it.
Yeah,
because it's not denominated in your local currency.
So I'm personally long Bitcoin, but that also brings us into this transition where we look at other alternative asset classes. So we'll kind of touch on a company that you guys are both involved in, because I am in the belief as well that the central banks won't go peacefully in the night, and I think that they're going to double down on what they have known to do, and that's more quantitative easing, lower interest rates, negative interest rates if they have to go there, anything to sort of keep the system going. So with that, it sort of is unfortunately going to create more winners and losers. And I think that you guys have, Michael, if you want to take this, I think you guys have started a company that kind of gives the everyday 9-to-5 guy an opportunity to invest in an asset class that otherwise has barriers to entry because of the sums of money that are needed to accumulate, for example, for a down payment for a house. That's becoming more and more difficult for first-time buyers, unless they have help from mom and dad. So it's like, unless you have the privilege of mom and dad that were able to get on, for example, the housing ladder, and are able to then pass down some of that wealth, it's almost impossible for a lot of people to actually get on that housing ladder. So it sounds like you guys have created an opportunity here, a company where you've lowered those barriers.
Can I jump in before Mike does on that? The best entrepreneurs solve a problem for a market that the market doesn't know exists, right? And they typically solve it through technology that creates an entirely new market. So we all know right now that if you're real wages and you're working to try to save money in a bank that makes no interest rates against asset price inflation, that entire population, an entire generation of people is being penalized and they're getting killed. They can't win. And so why I love what Mike's doing, why it's signed to help, and Mike and Steve are doing and joined, is because of that, because an opportunity to help those people can create an enormous business, but enormous good to humanity.
Absolutely. No, and I was we'll jump into this now, let Michael take it, but I'll certainly chime in. But Michael, you just maybe explain to people that obviously have no idea your company, just what you guys are doing and the opportunity that it presents.
Sure. Maybe to reflect on a couple of themes from Jeff's book, The Price of Tomorrow, I want to continue on the topic of technology being a deflationary force and assets being quite inflationary right now. At Addy, I think the whole team acknowledges that the majority of Canadians are directly excluded, so mine, yours, neighbors, friends, and family, from the real estate asset class. So what Addy is using it's using technology to really drive the cost of real estate investing essentially to zero through scale and automation. So our goal in the next 12 months is to enable 1 million humans to invest in real estate. And along with that, we have these 4 promises that guide us and give us these guardrails, how we can enable that. So the first thing is our promise of always having absolute accessibility. So at Addy, anyone can invest in real estate. And in the past, we had a residential, and today we have commercial real estate available on our website, where you can invest as little as $1 for 1 share. So you can get right into the market, and it's absolutely accessible to every Canadian of the age of majority. Our second promise at Addy is hands-off ownership. So So that goes from contracts to close and being a landlord to juggling maintenance. We handle all the details, and we have an extensive governance process in place that we use to pick the real estate, but also manage, choose the property managers, including one of our board members, Steve Evans, who's had a number of publicly traded REITs. I included one pirate pure industrial real estate that he took from a 20 million market cap right to, I believe, a just under 4 billion exit to Blackstone in the last couple of years. The third promise at Addy is that the fact that we are expert co-owners. So along with Steve Evans and our board of advisors, there is really quite a brain trust of due diligence being done for all of these properties. We enable the crowd to invest alongside of us. And then the cool thing that I really dig and that we've been experiencing quite a bit, maybe was more of an eureka moment for us, is the tangible aspect of this asset class of real estate. As all your listeners know, there's something about going by a piece of real estate you own. And since we enabled the investment into a property that you could actually go right through the drive-through, a lot of our owners have been going by and taking selfies in front of it. And for us, the amount of thanks we've been getting and the actual pride of ownership that you get from owning a piece of real estate is amazing for us to get feedback on. And that's what really compels us. And maybe if I could just share a little bit of our eureka moment for this was actually the acknowledgement that the majority of people are shut out. And it was one of our employees who came to us when they heard that a couple of the co-founders were investing in the syndicate. And they couldn't get in because our minimum check size was $50,000. And when that person really started drilling us and questioning us as to how are they supposed to save enough money to get a down payment, to get on this property ladder, if their savings are not increasing the same rate of return of everyone else, it's just unfair. And it was really us just trying to think about, there is a lot of complexity. You have a lot of high costs administrative from legal and accounting. And what we're doing at Addy is really thinking through a process engineering point of view, how can we use technology to add scale to this? So our goal is at speed to have 10,000 local owners into any property. In this property that we have in Chilliwack, we just crossed around 800 British Columbians who've invested. The lowest investment in that was $1, and the highest that we restricted to was 1,500. And the reason why we're restricting a maximum investment is because we want to come about this so there is absolute accessibility and there is enough room for everybody.
Yeah, so I'm personally invested in that Starbucks deal. It's just a small number. You may as well take a flyer on it, give the company out, but give it a try. But I guess, as I kind of told you guys prior to the call, was that one of my initial hesitations when you see the company, what's the, how am I getting ripped off kind of thing? What's the angle? It's, you know what I mean? Because you guys are obviously breaking down barriers here. So there's always going to be some skepticism. And I think what I liked about that after, discussing with you guys further was that there is no fees as of right now. It is strictly a technology startup. You guys aren't charging a 2% management fee and skimming fees off the top. So, I mean, can you explain that a little bit further? I mean, obviously you guys have at some point there's going to be a monetization route, but maybe just explain that for the skeptics out there. If you can comment on that.
Yeah, for sure. I think it's an acknowledgement that first getting access to these deals is really hard. I was actually surprised when I invested in an investment. It was more than I was comfortable doing. So I asked the issuer or the person doing the real estate investing if I could participate and if I could bring my friends and family along. When they said sure, I was surprised at how quickly I was oversubscribed. And then when I was at the lawyer asked if they could get in, and they said that generally they don't get access to the deals already done. So I think the first thing is acknowledgement that most of these great deals are done within a very small circle. So that's the first barrier to entry, that at Addy, we have this great board who believes in sharing these opportunities with everyone. And then the second thing are the immense amount of fees. And I don't know how many of your listeners participate in these commercial syndicates, but generally there's an acquisition fee, an asset management fee, an asset setup fee, a mortgage guarantee fee, a disposition fee, a capital raising fee. There's something called a carry where they'll take 20% of the profit. So the fees are immense. At Addy, there is none of those fees. And that begs the question is, wait, if these guys they're not making money on fees, how are they making money? And it's really back to that first statement. In the next 12 months, We plan on having 1 million members on our system, and we're going to monetize through a membership fee. So if you think about Costco or you think about Amazon, what they provide are goods that are almost essentially at 0% markup, and they make money through servicing their members to the point where these members are choosing to pay and choose to want to pay these membership fees on an annual basis. That's where we're going. That's why we want to ensure that all these properties that we do bring to the crowd are well vetted and good investments. And there is also an abundance of information, so these investors could go alongside of us and they could do their due diligence in real time.
So yeah, so through that membership then is you basically get access to the deal flows. And I will say this, like for myself being in the real estate industry, I'm more like on the residential side, but like, you know, I know how the development side works. I understand how like multifamily, particularly in the US, works. I've been involved in a number of those calls, but like it is basically like for the US multifamily side, they do take high fees. If you want to own into an apartment building, you almost have to know somebody to kind of get in. You have to be an accredited investor. You have to have a minimum of $50,000 US. So it's like there's all these kind of barriers where it is kind of, again, like it's great if you're if you're, you know, a higher net worth individual, you've built up your assets, but if you're just like, again, someone that has a little bit of spare cash, you're trying to build some sort of, you know, real assets, you know, underneath you, you guys have really kind of reduced that barrier to entry, which I think is really setting you apart. So through that membership, I'm assuming that you basically would just get full access to all the deals that you guys source out. One of those being the Starbucks drive-through in Chilliwack, which I'm a part of personally. What other kind of deals are you looking at? Are you strictly only looking in BC, and what do you foresee the plans here moving forward?
Mike, do you mind if I jump in just before?
Please.
Because I think just important in this whole thing, we would never put the crowd into something we weren't investing in personally. So we invest alongside every one of these as part of the due diligence process. And then we invite the crowd to invest at the same rate we did. Yeah,
which again, I think that's why, like, even as I told, you know, Steven Jagger, who set up this call for us, as I said, you know, like if I'm going to promote something such as Addy, like bringing you guys onto the channel here, which I have utmost respect and for my audience and the trust that they've instilled in me, is like I would never get behind something unless I was personally involved in it or had the utmost confidence in the people, you know, doing that. So that's kind of why I've invested in that one and was wanting to bring you guys on.
Thanks.
Awesome. Yeah, we appreciate your investment, and hopefully you get a chance to go grab a coffee at your Starbucks. I think to answer your question, our first issuance or property was this house on Trout Lake. It actually sits in the lake, incredible lot. And we offered that to all Canadians. And as a startup, we had a lot of learning. And actually what we learned from that is we wanted to restrict to allow more locals in. So for the first one, we had investors all right across Canada, 305 investors with a medium investment of $1,200, the lowest being $1, the highest being $90,000. So for this issuance on Airport Road in Chilliwack, we decided we wanted to restrict it only to British Columbians. And our namesake being Addy, being short for address or additional, we wanted to give a property where we wanted a definite focus on people who live in Chilliwack being able to invest. Going forward, we plan on looking at all properties right across Canada and offering additional issuances to people in other jurisdictions. And for the next one, we're definitely right now looking at properties on Vancouver Island and in the Greater Toronto area.
Yeah, no, that's awesome. And I think like once you guys kind of hit scale, it's more so like I think the tough part is getting access to the pipeline of deal flows, which is probably the biggest hurdle, I think, for a lot of people, particularly smaller time retail guys that want access to these, you know, commercial grade investments is you really have to have access to the deal flow. So you guys, again, have kind of, you know, reduced that barrier.
Yeah. And I think one of the things that we're super proud of is that you could take an online commercial real estate investing course, or you could actually, and I think Tim Ferriss said it best when he thought about doing his MBA. He said, you know what, I'm not going to do the MBA. Instead, I'm going to put $250,000 in $50,000 into 5 companies. I'm going to sit on the board and I'm going to get the real world lesson. I think another thing that Addy does promote, or not promote, but give the opportunity to, is you can invest as little as $1 and you could get access after signing your confidentiality agreement to all the due diligence. So you could actually get to see what do we look at to vet these deals. And it's a great, not only investment with cash being deflationary, but it's also an ability for you to learn and level yourself up as an investor into real estate.
No, it's awesome. Jeff, do you have any comments on that?
No, I just say that's the whole point. Is this is designed around solving a problem that a huge part of the population deals with. If you say it kind of where we looked at kind of on the bigger macro area, what's happening, real estate, even in wealthy people, is most of their middle class, is most of their value, right? And so when you look at what's happening, that real estate is all localized typically. So if somebody has to come up with a huge down payment, go in leveraged with huge debt to be able to buy into this market, and it's localized, so all of their wealth is concentrated. Concentration of risk in a portfolio is really good for making returns if you're lucky and right. Diversification is way better for making longer term returns, right? So this type of platform allows you to diversify your money across different asset classes, across different regions and everything else, so that in the eventuality is that in one region, if the government says we're going to increase taxes by an order of magnitude on this real estate, and you're in it, and it's all your wealth in it, it's going to collapse. Mm-hmm. Something like this allows you to diversify across different asset classes, across regions and everything else that protects you from that risk. So I love what this could do for a whole generation of people. There's lots of work to do in any company to build a company, but it's just I'm loving working with really committed entrepreneurs that are really great technology entrepreneurs that want to help society through their business.
Yeah, no, I think it's awesome. I think we've kind of like encompassed the whole piece here in terms of sort of the macroeconomic outlook, the monetary policy outlook, and kind of where things are going. And so I think that your company is kind of helping to tackle a lot of the issues and give people, an alternative to, kind of build their own assets and net worth outside of the traditional ways of doing that. So I think it's super exciting. Like I said, I'm certainly a supporter. I don't know if you guys had any sort of closing thoughts, but I'm sure what we'll do is we'll put a link in the description below where people can kind of go sign up. You create it. So I don't know, Michael, if you want to just kind of let people know how they can invest. I know that you guys are closing out the Starbucks deal here in the next couple of days. You want to just tell people how they can sort of subscribe to that?
Yeah, definitely. Just hit our website, Addy, ADDY, invest.com. Everything you need to make an informed investment decisions on our website. All the details are there. Sign a confidentiality agreement once you have an account set up, which you could do in under 3 minutes on your phone, and you get access to exactly the same due diligence we have.
Sweet. And then you send an e-transfer to the wallet there or something, and then they can roll it into the deal.
Yeah, that's right. You could fund your Addy wallet for e-transfer, or you could link to your financial institution and do an electronic funds transfer. And that's also how you'll get your distributions in the future.
Yeah, the distributions go directly into your account.
Yeah.
Awesome. Well, thanks a lot, guys. I appreciate it. This has been super enlightening, and I'm sure that the audience here will get a lot of valuable insights out of it. So I just want to thank you again for coming on. And I don't know, Jeff, I'll also put a link out to your book, The Price of Tomorrow. Highly, highly encourage you guys to check it out. It's a phenomenal read, and obviously being a local guy here in Vancouver, it's that much sweeter. So congrats.
Thanks, Steve.
Thank you, Steve.
Awesome.